Welcome to the Deep Dive, your go-to source for extracting the most important insights from a mountain of information. Our mission, to help you become well-informed, quickly and thoroughly. Today, we're plunging into the hidden mechanics of market movements. We're focusing on something that often kind of eludes casual observation, what are known as liquidity pools. Think of this as your essential guide, really, to understanding how the market truly breathes and moves, not just how it's commonly perceived on the surface.
Exactly. And we're going to pull back the curtain on the core concepts of internal and external liquidity, how to identify them, and maybe more importantly, why they often hold far more significance than, traditional market analysis. Our goal today is really to demystify these powerful algorithmic forces, hopefully give you those aha moments that genuinely transform your understanding of how markets actually operate.
Okay, sounds fascinating. So if you're ready to uncover some maybe surprising facts behind price action, let's unpack this. To start our exploration, let's get right into it. When we talk about liquidity pools in the market, what exactly are we referring to? And what's the fundamental distinction between internal and external liquidity?
Okay, so at its most basic level, liquidity in the market. Well, we're talking about specific areas where a high volume of orders are likely resting. Specifically, we're talking about what are known as buy stops or sell stops.
Buy stops and sell stops.
Right.
Yeah.
Yeah. These are essentially price points where lots of traders have placed orders, either to buy if the price moves up, that's a buy stop, or to sell if the price drops, a sell stop. And these areas become like magnets, because price tends to move towards where it can fill the most orders efficiently.
Okay, so it's drawn to these clusters of orders.
Exactly. So liquidity pools are basically targets for significant market participants, often the big institutional players, to hunt for these orders. And you typically find them above old highs or below old lows. That's just where stop-loss orders naturally tend to accumulate.
Right, the obvious places people put their stops.
Yeah.
So it's about identifying where that concentrated activity is waiting. And you mentioned two types, internal and external. Could you elaborate on internal first?
Absolutely. So think of internal range liquidity as something happening within the current immediate price movement. It's like looking for short-term lows or short-term highs inside a price leg that we're currently retracing back into.
Okay, so during a pullback, for example.
Precisely. If price has made a big move up, say, and then starts pulling back, we're looking for those smaller temporary highs or lows within that pullback itself. It could be a short-term higher low with stops resting just above or below it, or maybe an imbalance.
An imbalance.
Yeah, basically a gap in price action where there wasn't enough matching buy or sell interest at the time. It creates an inefficient spot, sort of like a vacuum, that the market might want to revisit later to balance things out. So it's all about finding those short-term turning points and inefficiencies within the current dealing range.
Dealing range.
Yeah.
Meaning the most recent significant price swing.
Correct. The immediate high and low we're currently trading between.
Okay, so that's liquidity within the immediate action.
Yeah.
What about external range liquidity then? How does that differ?
Right. External range liquidity is looking at something, well, bigger. It refers to a run on buy stops or sell stops outside of the current swing.
Outside, so beyond that dealing range we just talked about.
Exactly. Imagine the price is moving within a certain range, but then it pushes beyond that range. It's going after the stops that have accumulated past those more obvious, maybe longer-term highs or lows. This often involves the market, you could say, engineering buy-side liquidity on the basis of sell-side flow, or the other way around.
Okay, engineering.
Yeah.
What does that mean practically?
Well, think about it. When the market pushes up and takes out an old high, it's not just a simple breakout for retail traders. For the algorithm or larger players, it's activating all those buy stops resting there. And triggering those buy stops provides the sell liquidity they might need to initiate a large counter move, like a strong push lower.
Yeah, okay. So taking out the highs provides the fuel to go low.
Precisely. And the same logic applies in reverse when taking out old lows to sell stops there, provide the buy liquidity. It's a really key distinction because it signifies a move beyond the immediate short-term action. It often signals a potentially more significant shift in direction.
That clarity is really helpful for understanding the types. So internal is within the range, external is breaking outside the range to grab those older stops.
You got it.
Now, once we grasp what these pools are, can you maybe outline some core rules, for actually identifying them and maybe utilizing this understanding effectively?
Absolutely. And these rules, they really do fundamentally shift how you view market movements. It's quite different from standard approaches. First rule, and this is maybe the most crucial insight, recognize the algorithm's focus.
Okay.
The market's movement isn't random. It's not just chaotic buying and selling. It's fundamentally driven by an underlying algorithm that is actively seeking liquidity. It's not driven by conventional retail logic or simple supply and demand curves you see in textbooks. And this algorithm is consistent, it's predictable, and it's objective. Like, the algorithm will never be changed because old highs, that's always going to be buy-side liquidity. Buy stops are going to rest above that, and below old lows, there are sell stops resting below that. It's a constant.
So it's programmed to hunt these specific levels.
Exactly. And understanding this is key because, as one source puts it quite bluntly, these markets are absolutely 100% scripted and controlled by an algorithm. The market is quite literally delivered on the basis of liquidity and balanced rebalance. That's it. That's the only thing that's happening. It's a huge shift from thinking about, mass psychology driving every single tick.
Wow. Okay. That's a big statement. Rule number 1. It's algorithmic. What's rule 2?
Rule 2. Visual identification is often straightforward. Now, while the underlying mechanics sound complex, actually spotting these potential liquidity pools visually is surprisingly simple most of the time. The easiest, most obvious visual cues are old highs and old lows and relative equal highs and relative equal lows.
Relative equal highs, meaning highs at basically the same price level.
Exactly. When you see two or more highs or lows forming at roughly the same price level, those relative equal highs, for instance, are essentially engineered points. Why? Because every book tells every trader that reads the book that stops get above the old high, and this is resistance. So everyone clusters their stops there.
Making it an obvious target.
A perfect target for the algorithm. It's a dense cluster of buy stops just waiting to be engaged. Same idea for relative equal lows with sell stops.
Okay, so look for old high slows and these double tops bottoms, essentially. What's next?
Rule 3. Look for a market structure shift after a liquidity sweep. This is where the tactical application really comes in. It's not enough to just see price poke above an old high or below an old low. You need confirmation. You're looking for a clear break in market structure after that pool of liquidity has been taken.
A break in market structure. What does that look like specifically?
It means, say, when this run above these relative equal highs happens and the price has clearly absorbed those buy stops, you're then anticipating a market structure shift to the downside. Practically, this means you have to see it go below, and displacement with the energetic move take out a short-term low.
Displacement, meaning a strong move, not just drifting down.
Exactly. Displacement implies a strong, decisive, energetic move, not just a weak pullback. It shows real selling intent in this example. This strong move takes out a short-term low, which confirms the shift in structure, and it often creates the imbalance we talked about earlier, that inefficiency which price might later be drawn back to.
Got it. So liquidity sweep, then an energetic break of a recent low or high. It's going long. Yeah. That's the signal.
That's the sequence, yes. It's the confirmation that the liquidity hunt probably served its purpose and a new direction might be emerging.
Okay, rule 4.
Rule 4. Utilize time as a filter. This one is incredibly powerful but often overlooked. Time of day is crucial. The market's algorithmic principles are deeply tied to specific times. As one source puts it, time is the first measure in algorithmic principles. When is it happening or when is it likely to happen?
So it's not just what happens, but when it happens.
Precisely. It's not random. Specific setups, like for those fair value gaps, the imbalances they are known to form more frequently at specific times. You might notice, for instance, fair value gaps forming every 15 minutes on the 15 or 5-minute chart during certain sessions.
Interesting.
And more broadly, we talk about kill zones. These are specific time windows during the trading day when high probability setups based on these liquidity concepts are most likely to occur. And this is when your order idea and your order placement needs to be considered.
Okay, like specific hours.
Yes. For example, the London kill zone is typically cited as being between 2 o'clock and 4 o'clock in the morning. London time, that's your prime window for London session setups. And the New York kill zone often runs from 7 a.m. to 9 a.m. New York time. Focusing your analysis and potential entries within these windows helps you avoid chasing noise during less predictable periods. Time filters the possibilities.
Okay, that makes a lot of sense. Algorithm focus, visual cues, structure shift confirmation, and time filters. That's a powerful framework. It really does sound like a completely different way of viewing the market compared to, the traditional concepts like support and resistance everyone learns first. Can you elaborate a bit more on how liquidity pools differ from those ideas?
Indeed, it's a foundational difference. My whole approach and what we're discussing is fundamentally based on identifying and anticipating these liquidity movements, not support and resistance.
Not support and resistance at all.
Well, not in the classic sense. Those traditional support and resistance concepts, while seemingly intuitive, they often fail because they don't account for the highly precise algorithmic nature of how price is actually delivered in modern markets. Think about it. Those older textbooks and theories, they were written before an algorithm existed in this capacity. They simply don't reflect how current markets truly operate minute by minute.
So the game changed, but the old rules didn't update.
Essentially, yes. And a critical distinction here is that every old liquidity pool acts like an inefficiency. It's not just a static barrier that price bounces off. The algorithm will often revisit it and act as the opposite. So if we saw a buy-side liquidity pool above an old high acting as a magnet, drawing price up, once that liquidity is swept, the algorithm might then refer back to that same price area later and draw price down into it.
Ah, okay. So it's not just resistance broken becomes support.
Exactly. That traditional idea often doesn't hold cleanly. Notice how often price breaks resistance, pulls back, but doesn't find support there and just continues lower.
Yeah, it happens all the time.
Right, because the market isn't just reacting to a static level like a wall, it's precisely engineering movements to engage and utilize that liquidity for its next move. The core difference is that it's not supply and demand, and it's not support and resistance in the textbook way. It's about these specific ranges and price points the market's going to key off of with surgical precision.
Surgical precision. I like that. It's less about broad zones and more about specific price levels where orders are clustered.
Exactly. Less like bouncing off an invisible wall, more like being drawn to where the actual orders are resting.
That's a profound difference in perspective. Okay, let's test our comprehension, maybe solidify this a bit with a quick mini drill. I'll add 3 yes or no questions. Maybe you can elaborate a touch on your answer.
Sounds good. Ready when you are.
Okay, first one. If you're looking for lower prices, should your focus initially be on a run above an old high before you even start looking for that market structure shift down?
Yes, absolutely. That's the typical sequence. If your bias, your expectation is for lower prices, you are indeed looking for the market to first run above a relevant old high or relative equal highs.
Why start by looking higher if you expect lower?
Because that's where the buy-side liquidity, the buy stops will be concentrated. The algorithm often targets these areas first. Triggering those buy stops provides the necessary liquidity, the counterparty orders, for larger institutions to sell into heavily, which then initiates the move lower they intended. So once that forms, once that run above the high happens, then you're looking for a break in market structure on a lower time frame. That downward shift is your confirmation. Without that initial sweep of liquidity first, the subsequent move lower might lack conviction or be short-lived.
Okay, sweep first, then shift. Got it. Second question. If a new day opening gap forms, price gaps up or down at the open, is it a guarantee that the algorithm will always refer back to that same gapped area again at some point?
Yes, this is a fascinating aspect, the algorithm's memory, so to speak.
Mm.
Just because we fill the gap doesn't mean we're done with it. Even if price trades back into the gap area quickly, the algorithm often will refer back to that same area again, and it will do so for weeks and months at a time. Gaps represent significant inefficiencies.
Even weeks or months later.
Yes. Now, it's true that some gaps, particularly maybe a new week opening gap, might not fill immediately. Sometimes if it gaps up, it may not trade back down and fill that gap entry higher right away. But the concept that the algorithm remembers these price voids, these inefficiencies, holds true. They remain potential targets for rebalancing over extended periods.
Interesting. So they remain relevant points of reference. Okay, last drill question. Does understanding all this about liquidity mean you absolutely must aim to find and take a trade every single day?
No, absolutely not. And this is a really critical point for discipline. The goal is not to have a trade every single day.
But don't traders feel pressure to trade daily?
Many do, but it's a trap. In fact, it's explicitly stated in the source material. It's not my invitation or my goal to inspire you to try to trade every single day. Don't do that.
Yeah.
Your primary task, using this framework, is to focus on identifying and patiently waiting for your specific high-probability setup based on these liquidity concepts and time filters. Not every single day will present an A-plus opportunity aligned with your plan. Forcing trades just to be active, just because the market is open, is probably the fastest way to lose capital. Discipline means waiting for the market to come to you to offer your ideal setup.
Wait for your pitch, basically. Don't swing at everything.
Exactly. That's a great analogy.
Great insights from those drills. They really highlight the precision and patience required. So to maybe help listeners avoid common mistakes, what would you say are the top 3 common errors or pitfalls that new students make when they first try to apply these liquidity concepts?
Oh, yeah. There are definitely some common traps people fall into. First off, a major one is trading without a disciplined plan. Or maybe relatedly, just chasing price action impulsively. Many new students struggle because, well, you have to wait for the setup. You can't force it. You can't think it's there. It's either there according to your rules or it's not.
The patience factor again.
Absolutely. The market isn't going anywhere. But if you lack that discipline, remember this, your broker's not going to help you with that. They want you to click that button. That's how they make money. And they don't care if you blow your account. Harsh, but true. So you absolutely can't chase it. I don't care how good it looks later in the day, if it's outside your plan time or setup criteria. You don't do it. You have to have discipline, folks. It boils down to patience and strict adherence to your predefined strategy.
Okay, lack of discipline and chasing price. What's number 2?
The second major error is neglecting consistent journaling and backtesting. This is where the real learning and internalization happens, but it feels like work, so people skip it. The only way you're going to learn how to do this, really embed it, is by dressing your chart repeatedly for months. And honestly, you're going to feel like it's unproductive sometimes. That's normal.
Dressing the chart, you mean going back and marking up historical data.
Exactly. Actively marking up historical price action on your charts, identifying the liquidity pools, the market structure shifts, the time filters, the setups after the fact. Because if you're simply watching it like Netflix, you're never going to retain it, you're not going to remember it, and worse, you're certainly not going to be inspired to take the information you glean from it and go into your charts looking for it if you're not writing things down. You're wasting your time.
Active learning versus passive watching.
Precisely. The goal is to actively log your examples with your own annotations for your study journal. It's this hands-on process that creates that subconscious experience and deep personal understanding of how price actually moves according to these principles. You build screen time and pattern recognition.
Okay, so skipping the homework is a big mistake. What's the third common pitfall?
The third one is expecting perfection or aiming for a 100% win rate. This mindset is just incredibly dangerous in trading and totally unrealistic. It's vital to expect to lose money. If you're going to trade and you're using live money, you're going to lose money. It's a promise, I'm guaranteeing you.
That's blunt.
It has to be. You're always going to run into a scenario that will eventually lose capital, money will be withdrawn from your account. There is simply no method that hits every single time. None. And personally, you are never going to be perfect. You're never going to be right on every single trade or analysis. Understanding and accepting this helps manage expectations, reduces emotional decision-making, and keeps you focused on your risk management when those inevitable losses occur. It's about probabilities and consistency, not unattainable perfection.
Discipline, diligent practice, and realistic expectations. Sounds like solid advice for any skill, but especially trading.
Couldn't agree more.
Okay, those are incredibly practical warnings. To recap our whole deep dive then, if you had to boil it down, what are the 3 main takeaways we should absolutely remember about internal and external liquidity and this algorithmic approach?
All right, 3 key takeaways. First, internal and external liquidity aren't just abstract ideas. They define very specific price zones, where the market's algorithm actively seeks and targets resting orders. This is what drives price movement with that precision we talked about.
Okay, liquidity pools are specific targets.
Second, successful market analysis. Using this framework involves a meticulous process. It's about 1, precisely identifying these liquidity pools, 2, understanding how market structure shifts occur after those pools are engaged, and 3, applying strict time filters to validate your setups. It's a multi-step validation.
Identify, confirm with structure, filter with time. Got it.
And finally, number 3, this entire approach is fundamentally rooted in understanding algorithmic price delivery. It offers a distinct and often far more precise perspective compared to traditional retail analysis concepts like simple support and resistance, which frequently miss the underlying engineering of market moves. What we've really been discussing today, it's like the internal dialogue of what we're doing. We're looking at price, we're not thinking like the collective that is commonly referred to as the retail trader. It's a different lens.
A different lens indeed. Thank you for that really invaluable session. This deep dive has, I think, truly illuminated how the market operates on an algorithmic level. revealing a kind of hidden precision that I don't think many people truly grasp.
Well, it's more than just another technical indicator, right? It's really a fundamental shift in perspective. And hopefully it empowers you, the listener, to look beyond the surface noise and see the true forces often at play.
Absolutely. And to our listeners, we definitely encourage you to reflect on today's discussion. Maybe ask yourself, what long-held market truths or assumptions might you need to re-examine now, especially after hearing how the algorithm actively hunts for liquidity? Perhaps you'll start looking at those old highs and lows or those double tops and bottoms in a completely new light from now on. We genuinely love to hear your thoughts and any continued questions you might have. Join us next time for another deep dive into the fascinating world of knowledge. Until then, keep learning and keep exploring.